Good morning, all our viewers tuning in today to this special webinar series hosted by investmentguruindia.com. I'm Nirav Hemani, welcoming you all to this special series with CIOs. Today, we have a special guest with us, Mr. Rajeev Thakkar, CIO Equities at PPFAS Mutual Fund. So good having with you today, Rajeev. Hope all is safe with you.
Thanks, Nirav. Pleasure being here. Thanks for the
Thank
opportunity.
you. Thank you. Rajeev, top burning question among investors today is that during such pandemics or during such crisis, markets move in a very sharp direction. In March and April, we saw a sharp drawdown to the tune of 30 to 40%, to only recover smartly in July, August, and so on and so forth. And most companies have also posted drop in revenue numbers for the Q1 FY20. Given this backdrop, how are you reading this sharp divergence in the macro data and the share price movement that we are currently seeing?
So I think in the current pandemic situation and the post-pandemic situation, there will be polarization to some extent in terms of the corporate performance. So firstly, there are sectors which are not affected by the pandemic or which may actually benefit from the pandemic, whereas there are sectors which have had a severe adverse impact. So there will be one level of polarization depending on the sector. The other polarization will be the people who survive and come out of this strongly versus people who are either acquired or who have to shut shop because of the environment. So we have had sectors like, let's say, pharma and healthcare, telecommunications, IT services, e-commerce companies. All these kind of companies have either been unaffected or have gained from the pandemic in terms of more spend in those areas. And obviously airlines, hotels, multiplexes, amusement parks, these are the kind of businesses which have been the most severely affected. Now, if a sector is affected badly, and to top that, if the company is very, very leveraged, the company may not be able to survive, or there would be a shakeout in that business. So the stance that we are taking and what we recommend investors to do is to not so much focus on the headline index number, meaning the Nifty went down so much, Nifty went up so much, but look at the portfolio companies line by line and make sure that people are not exposed to spaces which have a very severe impact combined with leverage. So those are the businesses which may not come out of the pandemic on the other side, and to stay with reasonable companies. And the other thing is, as is always the case in any crisis kind of situation, the EQ or the emotional quotient matters more than the IQ, because if people are manic depressive, then this is a very, very bad time to be in the markets. So March and April was absolutely depressing environment, and there was a big crash. And again, in the current environment, one should not go overboard and saying, I am Superman and I can do anything kind of thing if your stocks are shooting up for no particular reason. So yeah, equanimity is important in the environment.
Right. Talking about individual portfolios, and you rightly mentioned that individual portfolio level is something the investors should look at, and not probably the headline index. When you see your individual portfolio, of course, it will have some volatility, and as of market, it will also go down and go up. How does one make sense of, let's say, I'm invested in 1 to 10 stocks, and do I look at the quarterly numbers? Do I look at the overall sector's perspective? How is it that an average retail investor can look at some of the data which is floating around to analyze the portfolio companies that he has invested?
So the first decision that the investor needs to make is whether to be a mutual fund investor or whether to be a direct stock investor. That is one level, and it's not binary. So you can have a combination of the two as well. So you can put part of your money in funds, part of the money in direct equity uh, portfolio. The important thing to uh, realize here is that I'm not claiming that uh, equity investing is only to be done by investment professionals, or just because I run a mutual fund, you should give money only to mutual funds. What I'm saying is, just like any other activity, you need interest in the field, you need some amount of expertise, and you, more importantly, you need to devote time. Now, for example, I may watch someone playing the guitar on TV and I may be inspired and I may buy an instrument, but if I am not able to practice regularly over many hours, then I'll not progress in that field. So the problem that most retail investors have is that they have far too many companies in their portfolio compared to the time they are able to allocate to track those companies.
Right.
That is the first point. So whether to look at quarterly numbers or not, see the for a retail investor, I think it's important to have multi-year perspective when they invest in a company, and
Okay.
obviously they can track the quarterly numbers and the performance, but sometimes it may beat analyst expectations, sometimes it may be lower than analyst expectations, but these things even out. As long as the management quality is good, the business characteristics are good in terms of high return on capital employed, low leverage, uh, those various factors, and valuation is not excessive, uh, too much attention is not required. People can read annual reports in more detail rather than obsess over every wiggle in the quarterly numbers. And again, I'll reiterate, it's important to limit the number of companies. So even investment professionals cannot track 100 companies per person. So if an individual investor has 30, 40, 50 companies, then it becomes difficult to track those companies.
True, true, true. Fair point that you made. Rajiv, over the past decade or so, India has seen tremendous reforms by way of implementation of GST, RERA, corporate tax cuts, and there are ample examples of it. And on the other side, India has also seen fair share of disruptions related to NBFC crisis, COVID-related lockdowns, economy under depressed condition. During such times, historically, we have seen market share gains at the hands of large organized players. And you also mentioned the point of polarization in your opening remarks. So while all of this is in theoretical looks very okay, do you think this consolidation across sectors is a structural thing or more transient in nature?
I think we go through various cycles. So, in any sector, uh, there is a disruptor which comes in where the environment changes very significantly for the sector. The weaker players get shaken out. There's consolidation which happens. Then the leader either becomes complacent or is not able to self cannibalize, or is not able to, uh, let's say, uh, identify the newer trends, and some newer player comes in, takes away market share. So it's not a linear fashion. It's not that the big will always keep getting bigger. Uh,
Okay.
it's a so let's say, let's take the example of stock brokerage, for example. At one point in time, you had a BSE club where either you had a membership card or did not have, and people could command premium pricing for simple stock trades and open outcry in the ring. NSE came in, opened up the market wide for anybody and everybody with a computer terminal, and that actually broke the cartel. So lot of newer brokers came in, but then you had the entry of institutional players targeting the retail segment. So you had the bank promoted brokerages, ICICI Direct and all, where combination of internet brokerage plus voice brokerage. So that had a big shakeout. Now you are seeing discount brokers coming in and trying to shake out the bank promoted brokerages. So it's a continuous process. It's not linear. Uh, in the current crisis, you will see weaker players being shaken out. But down the road, there'll be new startups surely. So newer players will enter the market if there is a gap and people see opportunity.
Right. Uh, Given the context of financials as a sector, because as a backbone, you cannot give away, GDP growth if financial sector is not performing to its optimum level, and also given a large representation in the headline index as well. Financials as a sector has its own fair share of disruptions and crisis on the credit side, again on the lockdown related moratorium side, and everything actually will probably in a quarter or two, we will probably come to know what the actual stress is in the NPA side. If someone is holding, say, a financials as a sector, as a portfolio company within the portfolio, how do you see financials as a sector emerging out on the other side of the tunnel?
So financials cover a broad range of companies and a large number of subsegments. So at the top level, let's split the financial space into areas where people get a fee income for a certain activity, and areas where principal is at risk, where the financial company is involved in lending money and getting interest on that, and on the other hand they would have borrowings from the marketplace. So the bigger impact is on the lending kind of businesses rather than the fee based businesses. So some of the financial related activities, let's say wealth management or stock brokerage or mutual fund distribution or credit rating or the exchange business or depository business, all these kind of things will not have that kind of impact of the COVID crisis and the moratoriums. Even on the lending side, it's important to segment it rather than do a broad brush stroke of the entire financial sector. So we have already seen, let's say, lending companies which lend against gold collateral being relatively robust in this environment, because firstly, gold prices have held up and in fact gone up in the crisis. So they don't have a problem of NPAs because the loans are fully secured. Again, mortgage lending companies where people have pledged their primary residence and where the credit standards were good, we don't see too many defaults happening. But if there's corporate lending or there's unsecured retail lending to weaker players, then there could be a spike in NPAs. So that segmentation is important to make. The other factor to look at is whether the financial company has a retail borrowing franchise. So do they have access to low cost retail deposits? So in this area, banks typically score better than some of the NBFCs. Of course, you have a couple of NBFCs which have good retail deposits as well. But this is very important because at a time when the wholesale markets lose confidence on some of the lenders, if you don't have access to stable deposits, even if your lending is prudent, you may be forced out of business purely because your liabilities are maturing.
Right.
So taking a combination of what is the proportion of fee-based income versus lending income, what is the nature of lending? Is it secured, unsecured? What is the nature of security? And what is the retail borrowing franchise? These factors would go into arriving at a decision. The other point to note is that coming 2 to 3 years may be difficult for the sector, but given the shakeout, the remaining players could see increased credit spreads and increased market share because their cost of funds have come down. They can keep the lending rates at previous levels because competition is reduced, and they can also grow volume because of more market share. So longer term, it may be good for stronger players.
Fair point. Fair point. Rajiv, there has always been a narrative of India that it's a strong domestic consumption story. And while it will drive a lot of GDP growth, we've seen demand side destruction and deferment of demand due to a lot of disruptions that we have seen. On the supply side as well, it has had its own fair share of disruptions due to lockdowns and other opening up of the economy. Do you see a revived demand coming in the discretionary consumable space? And part two of the question is this only a pent-up demand, or do you see it is only a demand deferment and not really demand destruction from that perspective?
So all of these are very, very important questions. The unfortunate situation is I don't have a very good answer for the good questions that you have raised. And the reason why the markets are so volatile is because people are continuously grappling with these same questions, and there's no clear answer right now. Everyone has more or less written off the financial year 2021. So people are not expecting anything great in the current financial year. The volatility in the markets is because of what people expect after that. So will we recoup the GDP loss for this current financial year, come back to par, and then again go on a galloping growth path? Is the fall permanent, and will we languish here for a long period of time? So you have all these kind of shapes, right? U-shaped, V-shaped, and then there was a K-shaped kind of thing. So no one knows. That's the correct answer. We have to see how it develops.
Sure, sure.
So I have given a non-answer. I realize that. But what is clear is that so even if you don't have a view on the overall economy, you can figure out individual businesses and individual sector trends. So in the current environment, clearly, I would think that e-commerce, shift towards e-commerce has accelerated because of this. Anyway, the shift from physical stores to e-commerce was happening. This has got accelerated in the pandemic. On-premise servers to cloud computing has got accelerated because of remote work. A lot of these IT tools are seeing increased demand. In a non-pandemic situation, probably you and I would be sitting in the same room recording this session. Today, we are comfortably using the Zoom platform to record this session. So a lot of individual trends are visible, even if you don't have the macro answer.
Understood. The reason I asked this question was also to do with, let's say, I'm invested in a set of companies, and today, if I'm looking out of the economic perspective, there are certain sectors doing well. There is a certain numbers. There are certain guidance given by the company managements. Do I make alterations in my portfolio looking at maybe next 6-8 months or maybe 2-3 years down the line, or else I stay do a bottom-up research and I stay firm on my ground that whatever probably I've researched, should I continue with that portfolio?
Sure. So when we do asset allocation for clients or for our own personal finances, typically equity investments are minimum 5 years, and the longer the better kind of thing.
True.
So irrespective of what your reading is? Will things normalize in next 6 months, or will it take a year for things to normalize? Will we get back to 5, 6, 7% growth, or will we have growth of 3 to 4% for a few years? This does not matter that much as long as your company selection, sector selection, and valuation is proper. These things should not matter so much in the overall portfolio context. The challenge comes where you have put short-term money in. So if you have money for 2 years or 3 years, then these questions become very, very important, because then you want to know precisely the date or the quarter when the recovery will start, which is always challenging.
True. And probably in the first place, you shouldn't be invested in equities if that was your view. Fair point. Rajeev, I wanted to ask this question that you've been looking at international markets, particularly US, in your portfolio as well. Data suggests that the US 10-year bond yield is at its historical lows, and probably it is going to stay there for quite some time. Oil prices have also remained low, 30-40% correction. Essentially, we have cheap oil and cheap money available in the US. Two questions over here. Is this any indication of US into a recessionary phase? And part two of the question is, will a lot of portfolio investors or the foreign portfolio investors look at India because interest rates are probably a little higher? There is a better opportunity over here. And probably India being a domestic consumption story, maybe, just maybe, it is more resilient to the current crisis.
Okay, there are multiple questions here. I'll try and address them one by one. So oil prices are down, I think, clearly when there are lockdowns or where there's reduced commute. Even after opening up, oil demand will be subdued. Air travel is drastically cut. Again, another source of oil demand. Again, longer term trends are that electrification is a reality down the road. We don't know in how many years that will happen, but electric vehicles are a reality now. So for various reasons, oil and GDP may not have that strong a correlation going forward. So if you and I were doing this session in a room, either you would have commuted or I would have commuted, or both of us would have reached some place and we would have consumed oil. Instead of that, we are consuming bandwidth on the internet. So for the same GDP or for the same output, the oil intensity has reduced to some extent. So that's as far as oil prices go. Interest rates clearly are down. So I don't think there's any question that this year GDP is in negative territory world over. So given that GDP is in negative territory, interest rates are low to and fiscal response is there. So monetary and fiscal, both responses are there to revive demand. So I don't see that as a cause and effect. So interest rates are not down because they anticipate future trouble. Interest rates are down because we are already in trouble because of the lockdowns and all. Developed countries versus India, I have a slightly different take on this. Okay. I would think that the fiscal response has been far stronger in developed countries than in countries like India because they have more space. They are richer countries. So to that extent, the demand revival over there will be faster. So firstly, you have seen Q1 GDP numbers. We are worse off than the developed countries. One, because our lockdowns were stricter. Number two, our fiscal response has been more limited as compared to developed countries. So in the US, for example, people just got thousands of dollars in their bank accounts for sitting at home saying, don't worry, government has your back, and go out and spend on your normal consumption needs. So I would think longer term India has potential in terms of the consumption story, demographics, all those things. But near term, I think the rebound in developed countries will be a bit faster. Interest rates, India versus US, surely Indian real rates are positive, uh, uh, barring the current elevated inflation, but interest rates in India are quite attractive as compared to the developed world. So on the debt side, one could see some interest down the road. So in government and corporate bonds, you could see some interest from foreigners.
Interesting point. Rajiv, PPFAS as a fund house have been known for its bottom-up stock research. And before you make an investment decision, you analyze the quality and valuation of a particular stock. Given that backdrop, uh, we don't want probably names of the portfolio companies, but can you elaborate on any sectors or any market segments that you are consciously avoiding currently, because probably you're not sure about the future? I think one or two points that you mentioned about airlines and the hotel industry, but if you could just elaborate that point, that are you consciously trying to avoid certain sectors or market segments, at least for now?
So historically, we have not been big investors in the capital intensive spaces. So infra or power or those kind of spaces. Also in the current environment, we are not invested in the airline kind of businesses or multiplex kind of businesses. So those are the kind of businesses we are staying away from, and we have a somewhat cautious stance on the lending businesses where the NPA front uncertainty is overhang on the market. So we don't know how things will pan out on the lending side. So largely these are the spaces we are cautious of.
Okay. The long-term equity fund that you guys are managing was one of the early proponents of international investing. And surprisingly enough, US markets have had one of the best decades in 2010 to 2020. And probably, some market segments in the US would have beaten the Indian market segment. The question is there a return expectation moderation to be done at the investor's end? Probably, one would say that don't look at the past returns and invest, but, however, tempting it becomes, should we, temper down the expectation on the return front currently?
That's a wonderful question, and the answer is unequivocally yes. So, firstly, one has to distinguish between nominal returns and real returns, which many a times gets ignored. So, if we are anchored to equity giving 15% or 20% kind of returns, that was in a era of maybe 10% kind of inflation. So, real rates returns were only 5% kind of thing. See, today we are currently in a year which will have negative GDP growth. We are currently having zero or negative interest rates in developed world. In India, short-term risk-free rate is around 3%. So, in such an environment, you should expect lower returns clearly in nominal terms as compared to past. That is definitely a yes in my view. Real returns, will they be lower? It could be possible because valuations are not very cheap right now, even factoring in the lower interest rates. So also the corporate performance in India for a while hasn't been that great, and again now we have the macro headwind. So definitely this is a period of, maybe in cricket analogy, it's a period of playing a test match or taking singles. It's not a T20 and you'll suddenly see final over, suddenly you'll see a lot of sixes being hit out of the ground. Definitely future returns may be somewhat subdued.
Interesting analogy. And talking about fours and sixes, there is a simple analogy that invest in mid caps and small caps simply because they have historically given fantastic returns. And currently the valuation of the headline index probably is at maybe January or February levels. Maybe no loss, no gain kind of a scenario over there. But the broader market probably looks down that way from a valuation perspective. Do you take that conscious call that, okay, valuations are looking a little fair or maybe cheaper when compared to large caps? Let's go hunting quality mid caps and small caps. Is that a frame of mind that you would propagate?
Sure. So, Professor Jayantar Verma of IIM Ahmedabad runs an interesting website, blog, where they track return contributions of various factors relating to the Indian market. So, academicians have long held that the size factor in investing matters, meaning the smaller companies tend to give somewhat higher returns. So, whereas the actual data for the Indian markets over 2 decades plus, I think, actually shows that that is not true. In fact, small and mid caps have probably done slightly worse than the overall market. And various other academic studies have also shown that you can make money by investing in small and mid caps, but you have to control for the junky kind of companies. The small and mid caps is a lot of companies which are just listed and don't have really that good a business, or sometimes the accounting policies are suspect and things like that. So even last, let's say 5-7 years, or maybe slightly longer, I think 7 years would be a good time frame. Let's say 2013 to 2017, small and mid caps had a huge outperformance. And when we are saying that small and mid caps have underperformed, it's largely we are looking at late 2017, early 2018 to current date. So actually, if your starting point is 2013, then it's not that big a difference in performance. So of course, we run a multi-cap. We go line by line. If an opportunity comes in small and mid cap, we buy there. If an opportunity is there in large cap, we buy there. But just as a data point, one of the fund houses, SBI Mutual Fund, they've in fact shut inflows for their small cap fund. So that is a signal probably that they are not finding too many opportunities in the small cap space in the current environment. So yeah, I think rather than making these binary decisions saying invest all in small cap or invest all in large cap, one has to go company by company while selecting. And if you are allocating money to large cap, mid cap, small cap, that kind of approach, then stick to your asset allocation. The other option is invest in multi-cap funds. Or the third option, if you are a direct stock investor, is it depends on the company largely, as opposed to whether it's a large cap or a small cap.
Right. And, interesting data point from an industry perspective. So Amphi just released its daily numbers, and over a period of last maybe 4 or 5 years, we have seen robust positive inflows into mutual funds. That could be an indication that, a lot of investors have now taken up, equity investing very seriously. Of course, the August number looks a little disappointing. Do you see there is a profit booking across the board? Are investors probably looking at the first opportunity to exit? Or what could be other factors which could probably lead to some large-scale redemptions that we are seeing currently?
I think it's a mix of two or three factors. So of course, we interact with end clients and even people like you who have a pulse of the market and who interact with clients more closely. I think broadly there are two or three different factors in play. One is there would be a segment of people who would have, unfortunately, cash flow issues in the current environment. So, business people as well as salaried people, if there have been pay cuts or if there have been layoffs, that would impact the incremental inflows as well as cause outflows some of the time. So, in some cases, people may be dipping into their savings to access the money. That is one end. Second would be profit booking, saying I've bought many years back. I'm making decent amount of money. My goal is 2 or 3 years away. Why take the uncertainty of market movement in the interim? Let me redeem and keep the money. It could also be that people are selling at a loss where they are panicking because of the headlines, say COVID cases are rising or GDP contraction, and people panic. The other factor, which is a perennial factor where across centuries it happens, is that people drive the car looking only at the rear view mirror. They don't look out of the windshield. So, trailing returns from equity will look horrible if you are evaluating end 31st March, right? And if you are evaluating it today, the numbers will look very different. So when you look at your past SIP returns or past lump sum returns in a bear market, returns look extremely depressed. And if you evaluate it at the peak of a bull market, returns look very rosy. So sometimes people have this backward looking approach where they look at the past 3 or 5 year return and then do tactical asset allocations. So some of it could be on account of that reason. Now, how much proportion is to be attributed to which reason is difficult to say. But broadly, the fact is that last 2-3 months, flows have weakened, and in equity funds for the industry, it has been at a negative level.
True. And in fact, it reminds me a simple analogy. If Sachin Tendulkar was probably evaluated on 3 to 4 innings of probably he gets out on a duck, and then you say that, okay, he has not performed, so he'll probably not perform in the future. And then you have series of centuries which the master hits, and then you say, oh, we were so horribly wrong. So I think fair point that you made. Rajeev, one question. On the small cap space, of course, the smallest of the small cap space, which is the startups. India, over a period of maybe 10, 12 years now, has mushroomed the startup ecosystem. Government has played a lot of role. A lot of entrepreneurs have jumped the bandwagon. Probably VCs have also looked at the Indian startup ecosystem more seriously, and some brilliant disruptive business models that have come in. You also mentioned the fact that probably the largest of the largest companies could get disrupted by maybe a startup company. As an equity investor, I'm sure you're looking at the listed space currently. How do you keep your eyes and ears open for, let's say, probably a startup in the e-commerce space, or somewhere on the edutech side, or the other sectors that you may be looking at mushrooming, and then you probably see that, okay, the portfolio company probably would have invested in maybe at a risk because if they don't disrupt or innovate themselves, probably there is someone else. So how do you keep a track of small cap companies or maybe startups in particular?
So given that we are largely listed equity players, our tracking of startups is more from secondary media resources. So it's not so much of a primary research where we have too detailed interactions with the founders or with the investor relations people of the startups. In fact, one of the not really a complaint, but a statement on the environment in India right now is that even after these startups come to a certain size, unfortunately, we are not getting those listings in India. So let me give you some names. Let's say a company like Uber or Lyft is listed in the US markets right now. In India, you don't have Ola listed here. You have Make My Trip and Yatra, two portals which are successful, but they are listed in the US markets. Flipkart never got listed here and has been acquired by Walmart. So the problem is that we don't even have successful or even post-startup companies listing in India in many cases. So which deprives Indian investors of a lot of opportunities. I don't know what are the real reasons. Maybe the founders and regulators need to sit across a table and figure this out. But as a listed equity investor, I feel I have a feeling of missing out on some of these things.
Yes, and also you alluded, to my next question is that we have had a lackluster IPO, season, so to say, maybe last 3 to 4 years. Back in 2007, we had, many IPOs coming in, maybe 2006 as well. Do you see companies are refraining, to get into a listed space? Are there some real challenges which can be explained over here, or is this probably a temporary phase and probably once market looks a little okayish and the GDP is back on track, maybe a quarter or maybe a year later, they would all come back, heaps and bounds to raise funds from the primary market?
So I think the IPO market is already reviving. If you see the kind of companies lined up, so you will see probably UTI AMC coming out with a listing. You will have CAMS coming out with a listing. You have Happiest Mind, I think, which one of the tech companies coming out with a listing. National Stock Exchange listing is on the cards. There's talk of LIC being listed. So I think IPO market will revive. I don't see that as the issue. There has been a big lull in the past, but I think work is happening on the IPO front now.
Right. And probably that will also, as you rightly mentioned, probably have more investable opportunities within the primary market and, of course, once they get listed into the secondary space. Rajeev, one final question on your philosophy, on your thought process of running the long-term equity fund. You have mentioned that you guys follow a value investing style approach. And one of the articles that I read that you have two lines of approaches when it comes to value investing. And which style of value investing do you follow for your Indian portfolio companies? And also the same style applies in your for your US portfolio companies as well. So if you could please explain.
Yeah, so the first version of value investing, as people know, Benjamin Graham and David Dodd popularized it, where they looked at the statistical measures of value. So cheap stocks, low price to book stocks, low price to earnings, high dividend yields or high cash on balance sheet, net as they would call, where if you liquidated the company, even then you would get more than the current market cap and things like that. So that worked well in the post-depression era when Graham and Dodd were practicing. But later on, practitioners like Mr. Buffett, Mr. Munger, Philip Fisher, all these people realized that there's a better way of doing things where instead of buying okay kind of companies at very cheap prices, you do better when you buy high quality companies at reasonable prices. And this is very relevant in the current environment, and especially even in India, because in India you largely have business family promoted companies where promoters, as they are called, they own 50, 60, 70% of the company. Now it's very difficult for minority shareholders to bring about any change or to create value unlocking. You have activist investors in the US who will do a corporate trade and force a spin-off or change the CEO. Those kind of things don't happen in India. So the better way of investing is to buy great quality companies and buy them at a reasonable price. And this has worked well both in India as well as abroad. In fact, the statistical cheapness kind of value investing school has had a very tough time in the current environment because cheap has been getting cheaper more and more rather than going up towards the perceived fair value.
Right. One final thought, Rajeev, a lot of investors ask us that when you invest in US, you are probably, looking at the largest economy, and GDP numbers on a vis-a-vis basis, India look probably depressed because it's a large economy, it is already well established, it's a developed market. They always argue that why to look at an economy which is doing okay, and probably look at Indian market, and where foreign portfolio investors are themselves putting in money into Indian market. So why is that a divergence, and why should someone look appropriately at a US equity?
Sure. So I can go on and on for this question. I can probably do a webinar only on this question, but let me answer it briefly. Firstly, the country of listing is not the country of operation. So if you are buying Tata Motors in India today, you are largely buying into Jaguar Land Rover, which is a developed country play. Tata Consumers, earlier Tata Tea, it's a global business. It's not just an Indian business. Hindalco owns Novelis, Tata Steel Chorus. Again, commodities are global in nature, so it doesn't matter whether you buy ONGC or ExxonMobil. If crude oil price comes down, both of them will fall. Because India's GDP is growing doesn't mean ONGC will be able to increase its production of oil. That depends on geography and geology rather than GDP growth. So various reasons. Again, as I said, Make My Trip Yatra are listed in US, not in India. Suzuki, which is a Japanese company, is largely participating in the Maruti story of India. Facebook, Amazon, Netflix, all of these companies, Microsoft, they are global businesses. They participate in GDP growth of India because they operate here. So there are various reasons. And again, the GDP growth of a country and the stock market performance, people have done correlation. People have found either a zero correlation or sometimes surprisingly even a small negative correlation. So yeah, look beyond just the home country.
Right, and also the simple platform that we are trying to use today, Zoom, is a US company. So probably makes a fair point that economies are interconnected, interlinked, and there is a lot of globalization happening. And so there you have it, Rajeev Thakkar, CIO from PPFAS Mutual Fund. Remember, guys, they run just rather two equity funds now with a tax saver fund coming in. And they have a liquid fund as well. So good having you, Rajeev. Thank you so much for taking time out. Remember, mutual fund investments are subject to market risk. Please read all scheme documents before investing, and please do consult your financial advisor before making any investment decisions. And I hope you had a meaningful interaction with us. Thank you so much.
Thank you.